While the masses piled into bets against the dollar, convinced of its doom by endless Fed printing and global shifts, the brutal irony, my friends, is hitting us just like a freight train right now. Because money markets are blasting emergency signals, cash is vanishing at warp speed. It's fueling a vicious squeeze that could vaporize trillions from the stock market, ignite a cascade of bank insolvencies, and catapult us straight into the mother of all financial crises. And what we're witnessing right now is a stealth precursor to a dollar-starved liquidity meltdown, where suddenly everybody's clawing for greenbacks after wagering on its downfall. And tune out this warning, and it could ravage your savings, obliterate your job security, and crush any chance you have at wealth creation. Now, this isn't sensationalism. It's ripped directly from the Fed's standing repo facility that set records this week with a staggering $50 billion surge in demand on Friday as banks, strapped for cash, battled for it against month-end chaos. Now, buckle in, because we're diving deep into why this flips everything you thought you knew before the fallout hits your wallet. Now, the surge in repo rates has spurred a dash to the Fed's liquidity facilities, some of which it introduced as a backstop after the 2019 turmoil. Now, to understand what repo is, it's the overnight cash lending markets. So when you see rates rising here, it's not a good sign. In fact, what it's telling you is those who normally lend into the overnight markets, well, they don't want to, and they're demanding higher interest rates out of fears that they won't get their money back. What this does is it signals trust is eroding and the dollars are getting scarce. Now, the Fed's standing repo facility, which allows eligible institutions to borrow cash in exchange for Treasury and agency debt. Counterparties on Friday tapped again $50.35 billion. This is the most since the facility was made permanent in 2021. So when repo providers don't want to lend, borrowers have no choice. They turn to the Fed, they're the lender of last resort. And as demand for repo rises at the Fed, it's a sign that liquidity or dollars are drying up and fast. Now, why does this hit home? Because I want you to be thinking, fewer dollars in the system, it means layoffs skyrocket as businesses can't borrow, asset prices plunge that can tank your portfolio, and what we start to see are delinquency rates rising that could push banks right toward insolvency as cash exit the system at rapid speeds. Now, benchmarks tied to repo transactions such as secure overnight financing or SOFR and tri-party general collateral repo rate have moved above the rate the Fed pays banks to hold reserves. So what we're facing here is an indication that dollar liquidity in the financial system is not robust as it once was. But now they've got a problem. Liquidity is tightening and in a big way. The dollar's starting to rally, and what it's doing is threatening to hammer tech stocks, gold, and crypto. Why? Because those were the darlings of the short dollar trade. It said short the dollar, borrow the dollar, and buy things that are going up. And what this squeeze threatens to do is unwind them all with brutal force. Now, this liquidity rout just isn't confined to American shores. It's a global plague that's infecting economies all the way from London to Beijing. What this is doing, my friends, is creating a vicious cycle of tighter credit, spooked banks, and vanishing cash is primed to hammer growth worldwide. Now, first up, let's turn to the UK, because it's flashing its own distress signals right now amid post-pandemic hangover that's long and far from over. We can see that sterling repo rates are proving more volatile as a BOE continues selling down its gilt portfolio and as banks repay cheap loans from the pandemic. So the problem is they borrowed all this cheap money during the pandemic and they don't have the cash to pay it back. Now they're forced to borrow at even higher rates, which is going to squeeze their profit margins and lead to even tighter lending standards. Now here's the proof, because I want you to see how tightening lending standards inversely tracks profits. Let's turn to this chart of net percentage of domestic banks tightening standards for commercial industrial loans to firms of all sizes. That's shown in blue. It's corporate profits after tax in red. And what you can see very clearly, let's go back to 1998. What happens? Corporate profits in red go into contractions. They fall below that horizontal black line. What happens? Banks tighten lending standards. They do it again going into the dot-com bubble, the financial crisis. We can see right around 2015 into 2016, before the pandemic, when the Fed was panicking and doing QE again. And then you can see it's been happening again with profits now looking to enter contraction again. Banks are likely to tighten. Now think of this from the consumer's perspective. We're seeing layoffs increase. We're seeing hours work drop. Consumers are going to look to the banks to borrow money, and they're going to start saying no. Now, when it comes to trading, we put the probabilities in your favor. Now, how do we deliver big returns like this for our subscribers? Well, it's very simple. We have optimized all our strategies on a per security basis for 10-day forward returns. Nobody else has done this. And based on our data, when we generate a trade signal, we can tell you the win rate and the positive expected return. Now, how do you get in on trades like this? Because we just put out an amazing trade for our subscribers for Monday. All you have to do, grab those links in the description below, use the coupon code for your free 30-day trial. And while you're there, there's a full video walkthrough of both my subscriptions so you can see how we put the odds in your favor and more money in your pocket trading than ever before. So what we're seeing is not only the banks facing a profit squeeze, but as the economy slows, banks are going to start worrying about getting their money back. And that's exactly why they tighten lending standards. So what you're seeing here, it's a textbook squeeze. Banks start to worry about repayments as growth slows, so they slam the brakes on loans, amplifying the cash shortage. Because remember, commercial banks are the ones that create new money when they originate a new loan. And what that does is send the repo providers into hiding, because banks are replacing the funding they lose from repaying the loans by tapping the BOE's liquidity facilities. On Thursday alone, banks borrowed a record $98 billion from one-week repo operations, following a similar strong demand in a separate 6-month auction on Tuesday. Borrowing to repay old debts? That's a glaring admission by the UK banks that they're also cash strapped. Now let's pivot to Europe, because things there, well, they look deceptively calmer on the surface. But when you dig deeper, you see the cracks. Well, they're widening. In Europe, funding markets are calmer, with core repo rates showing little signs of pressure. However, there are signs of tighter liquidity feeding into the unsecured borrowing rates. So what we're seeing here is tighter liquidity means there's less currency. In this case, there's fewer euros. And what happens when you have less currency? It leads to rising defaults. Now, the euro short-term rate has been gradually converging with the European Central Bank's deposit rate. This week it hit the tightest spread since 2021, reflecting greater demand for cash as excess liquidity is drained from the euro financial system. Now, what's going to happen here is everyone's going to point at central bankers, but they're missing the bigger picture. So why is this bad? Because it reflects the surging cash demand as the ECB continues to unwind its balance sheet. So again, in the forefront, everybody's going to blame central bankers here, but as they end all of their tightening measures, well, it's going to be obvious there's a much bigger problem. So when you look all around, not just from the US, you see UK to Europe, cash is disappearing from the financial systems at an increasing rate. But the problem is, if you think Asia's immune, not a chance. Let's take a look at China, because China's central bank is expected to resume buying of government bonds soon in a bid to inject cash and help cap government borrowing costs. Now that's what they want you to believe, because central bankers, they'll never tell you the truth. Reality? China's banking system is running out of money, and I've been warning about that for a long time. Problem is, the PBOC can't figure out how to stop it. In fact, Governor Pan Gongxing has also called for measures to maintain ample liquidity in the banking system to fully meet the financing needs of the real economy. So now we have the truth, or at least something a lot closer to it. Because what he's suggesting here are Chinese banks are loaded with souring loans, particularly in the real estate market, all along the fact they're dealing with a weakening and slowing economy. They don't want to lend. So what the banks have been doing is they've been buying CGBs or government bonds despite Beijing's threats that interest rates are going to go up because they want the banks to lend. The banks are saying, we're seeking safety here. See, it's not about financing needs. It's about the fact that banks don't want to lend and the PBOC doesn't know what to do. So they believe if we just inject cash into the banks, they're going to go out and lend, they're going to support the economy, and then it's going to turn around. But just watch. You want to know what the banks are going to really do with that cash? Well, if you said they're going to buy CGBs, you got it right. Now, when the banks start scrambling for liquidity and safe assets, they cut back on their lending activities. And what you start to see are delinquencies. They start to rise because there isn't enough money to pay on all the debts. And next thing you know, those delinquencies, they turn into defaults. And after that, companies start to lay off as demand dries up. And here's the proof. Let's take a look at this chart of commercial industrial lending versus the delinquency rate on all commercial loans. This is US data here, but I want you to see very clearly as commercial industrial lending in blue decelerates and enters a contraction below that horizontal black line. Well, what happens back in 1989 going to the early 90s? The delinquency rate on all consumer loans goes up. You see it happen again during the dot-com bubble, the financial crisis. You see it happen right around 2017, going into the pandemic. And look what happens post-pandemic. As loans crash, delinquency rate rises. Because what I want you to be thinking here is there isn't enough money to pay on all the debts. And that's why you start to see the delinquency rate rise. So what is the Fed's end game here? Well, they already announced that QT is coming to an end on December 1st. And what they're trying to do is they're trying to stem this liquidity bleed before it spirals. But remember, they only have two policy tools. They have their balance sheet and they have the funds rate. So far, the funds rate hasn't worked. And we could see because they lowered the funds rate on Wednesday. And what did we see on Friday? A record grab for the emergency lending facility. Now, what does this mean? We're likely going to hear at the next meeting the announcement of the restart of QE. Now, the Fed's already indicated in previous conversation they're going to target the front end of the curve. They're going to be buying T-bills, swapping that with cash. But one of the issues here, and this is why it doesn't work, and I want you to understand this, is when Fed does the QE swap, that cash is stuck inside the Federal Reserve System. So the question is, will it work? Well, if we go back to 2019, remember the QE patch? Well, it didn't work. We got about 6 months of calm before things started to fall apart again. Now, the problem is for the inflation, the Fed wants you to believe that QE leads to it. And right now, for a lot of consumers, that's not good news. In fact, it would further risk trapping us in a stagflationary spiral, and that would lead to hell for a lot of consumers. Now, there's no silver bullet, but I want to uncover the real reason liquidity is disappearing and why central bankers are powerless to stop it and what you can do to protect yourself. Because the central bank's panic pivots, they're not going to save us from the squeeze. Now, they'll just delay the inevitable reckoning by convincing Wall Street and investors and banks to keep the liquidity spigots flowing. But it won't last. Because what is the real problem here, my friends? Well, it's a post-pandemic. If we look at the debt, we can see it balloon. In fact, GDP grew, but debt, we now saw it jump by 10 plus trillion just here in the US alone. Now, this led to stocks hitting all-time highs, but underneath what it did is it masked a grinding economic slowdown underneath that avalanche of debt. So the problem here is money vanishes as loans get repaid, with principal vanishing from the system. And right now, that anemic economic growth, it can't spawn enough new cash to cover the interest, let alone all of the debts. And that's why these liquidity gaps get bigger and bigger. They start as cracks in subprime, and then they morph into an all-out crisis. And it's all because the debt machine of a debt-based economy, it prioritizes the repayment of debt. So what you start to see is cash hoarders starting in the repo markets. Well, they clamp down on lending and jacking rates up and fueling the dollar rally that we've been seeing as borrowers beg for greenbacks and soon will be begging at any cost to pay back on their loans. Now, again, the Fed can come in and swap cash into the banks, but it doesn't solve the problem. It's simply a Band-Aid on a financial system that's starting to hemorrhage. And when it breaks, it's going to create huge opportunities for those with dollars. And here's what you can do right now to set yourself up for a massive profit. I want you to consider taking profit on your high-flying tech stocks and rotate them into defensives. Put dollars in your portfolios. I'm talking real dollars. Buy short to intermediate term bonds because it will follow the Fed cuts down. Want to hedge your gold positions? Remember, what we're facing here with the second rate cut is a bear setup for gold, but you want to look to buy back in on the major dips. You want to lock in your high-yield savings right now before it's too late. Cut your budget and start to pay down your high-interest debt. Do these things now and you won't just survive the next liquidity crisis, you're going to come out wealthier than ever. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.